Let's speak now to Tony Crescenzi. Tony is the Senior Vice President and Market Strategist at PIMCO, the world's largest manager of bond funds. He joins us live. Tony, welcome back to Bloomberg. Always good to have you on.
Thank you, Mark. Thanks
Tony, we have been talking about this mixed data that we're getting today. We see the biggest drop in retail sales since September, but an increase in consumer confidence. What do you make of this?
Well, one has to put the consumer spending figures in context. Remember, there were very robust readings the prior 2 months, and so it's really hard to say whether there's some shift in momentum or if it was some backpedaling from the prior 2 months. And there were some details within the data, such as for building materials, where there was a very robust gain the prior 2 months of near 17%. It backpedaled by near 9% in the latest month, and it may have to do with the cash for appliances program, lesser known perhaps relative to the cash for clunkers program. It affected appliance sales, but the big question remains whether or not the turmoil in markets worldwide is affecting consumers now, and CEOs more importantly, because that'll affect ultimately, of course, consumers through the income channel.
Well, Tony, even given this information that we heard today, we do see Treasuries on the rise there, relative safety of U.S. government debt. What are investors to make of that?
Well, Treasury's been a bit volatile of late, of course, and today's ups and downs just might reflect some of the tension, I think, that's in the market about which way we're headed. I think the general tone, of course, for Treasuries, the move downward in yield reflects the turmoil in the world. And one might look at the 10-year and say it's expensive because it has traded at 3.20 to 4% this year, and so it's at the lower end of its yield range for the year. But what is it expensive relative to? One has to consider the inflation rate, for example. The CPI for next Thursday will be released on a year-over-year basis. It's up 0.9% to 44-year low. So relative to inflation, it doesn't look all that expensive. And secondly, if you were in a storm, consider if your home were falling apart in the midst of the storm and someone walked up to you and said, hey, I've got an insurance plan for you. It costs a little bit more than it did yesterday, but you, in the midst of the storm, might say, well, I'll take that one, because they're worried about what could happen. So those who are in the storm, those who have risk assets, might be willing to buy that insurance given what the risks are right now.
Right. Tony, what do you see going forward as shaping the financial markets? Is it something here in the U.S., or is it the sovereign debt crisis we see now in Europe?
Well, the sovereign debt crisis is, of course, a secular issue. It will be with us for many years. The debts of these nations won't be erased overnight, so we would expect these to be influences for quite a bit of time, and that means low policy rates more than likely to help offset the effects of austerity measures worldwide to bring down these debt levels. And so that will be the big influence, the overriding influence. The cyclical forces, those that basically drive the economy and markets, of course, over a 6 to 9 month or a year span, those will affect some of the volatility that you see in the financial markets. But one has to always be mindful of the secular issues, because those are big overriding themes that essentially dictate the ultimate direction of financial markets.
Tony, is what we're going to see now that's going to drive this economy here in the U.S. going forward, is that going to have to be led by job growth?
Ultimately, it is, because to achieve so-called escape velocity, where there's a self-reinforcing cycle of increases in production, income, and spending, one has to see, an economy has to see job growth, because income growth is what fuels that self-reinforcing cycle. And so the big question is whether or not the turmoil worldwide is affecting CEO confidence, and whether they'll continue to add workers as they have the past 5 months. It's a big question, but likely it is already affecting confidence, and we'll have to see how the summer months play out in terms of whether or not the dilemma, the sovereign debt dilemma in Europe, affects markets, and it's through markets, that channel particularly, that the U.S. gets affected. Okay, well, as we see now, because as you mentioned, some of these nations, apparently their balance sheets have been exhausted. You talk about a Keynesian endpoint. Tell us what that is. Well, for decades we've been told, policymakers have been telling us that the use of the government balance sheet to offset economic crises is the way to go. In 2008, countries decided to go Keynesian, so to speak, to use their balance sheets to support their economies and their financial system. But now there seem to be no balance sheets left to be tapped. You could say that this is the Keynesian endpoint, in the sense that what balance sheet remains? Where does Europe get its funding if it decides, of course, to go ahead and sell Eurobonds in its special purpose vehicle that will be used to support the nations that are in trouble? Will it go to China? Is Is China ready to take the world stage? Probably not. And is there a big enough balance sheet to support Europe? Probably not. And so we might have reached the end point where countries have to backpedal on Keynesian-style policies to bring down their debt levels. And this is what we're seeing in Europe. Austerity measures are meant to bring down debt to GDP ratios.
Do a lot of people, Tony, think that might be sacrilegious to back away from the Keynesian style?
No, because the debt to GDP ratios in many nations is just unsustainable. Consider Greece, of course, a debt to GDP ratio of 150%. How does it sustain itself if it continues to increase its level of debt? Bond investors will say no, and it won't fund, the investors will not fund these nations. And so the last balance sheet has been tapped in that sense because investors have decided it's too risky. We will only invest in those nations that have stable or improving debt to GDP ratios and sustainable fiscal stories.
All right, Tony Crescenzi, PIMCO Senior Vice President and Market Strategist, joining us. Always good to have you on. Thank you so much.